You know that moment on payday when your phone buzzes, you open the banking app, and you see the deposit hit. For a split second, there's this little dopamine rush, this small flash of relief. And then, almost immediately, your brain starts doing the math. Rent comes out on the 1st, car payment on the 5th, credit card minimum on the 12th, utilities somewhere in there, groceries this weekend. And by the time you're done allocating, that number you just saw, that number that felt so good for half a second, is already spoken for, already gone, sometimes already negative depending on the week. Most people will tell you the answer is to budget better, to track every dollar, to build a 6-month emergency fund and live below your means. And if you've actually tried any of that, you know exactly how condescending it sounds, because you have been living below your means. The problem isn't that you're spending too much. The problem is that the paycheck itself, the very thing you trade your hours, your weekends, your back, your sleep for, has been quietly engineered against you. And once you see how every payday is going to feel different for the rest of your life. My name is Max, and welcome to the Breadline Fix, where I spend way too much time pulling apart the systems that quietly decide whether ordinary Americans get to build a life or just survive one. If you've ever stared at your direct deposit and wondered why it disappears so fast, hit that subscribe button. YouTube does not surface this kind of content unless viewers actively tell it to, and a thumbs up genuinely matters more than you'd think. Now, before I walk you through the actual mechanism, I need you to understand one thing. When I tell you the paycheck is a trap, I don't mean your employer is cheating you. Most employers aren't. I mean something far more uncomfortable. The structure of how Americans get paid, the timing of it, the deductions inside it, the taxes layered onto it, and the expenses calibrated against it, has been shaped over decades by forces that have nothing to do with whether you can build wealth. And the result is a financial instrument that looks like income but functions like a leash. Let me say that again because it matters. Your paycheck looks like income. It functions like a leash. Long enough that you don't feel choked. Short enough that you never get away. Here's the first piece of the trap, and almost nobody talks about it. The timing. In the United States, the dominant pay structure is bi-weekly, every 2 weeks, or twice monthly. That's the system. You work for 14 days. Then your employer holds onto that money for another 7 to 14 days. And then you get paid, which means in any given month, you're essentially extending your employer an interest-free loan of half your monthly wages every single month for as long as you work there. Multiply that across the entire American workforce, and you're talking about hundreds of billions of dollars of unpaid labor floating inside corporate accounts at any given moment, earning interest for them while you wait for your money. That sounds technical, but here's why it matters in your actual life. The bills do not wait. Rent is due on the 1st regardless of when your paycheck lands. Utilities don't care about your pay cycle. Insurance premiums don't sync up with payroll, which means most Americans are perpetually operating with a 1 to 2 week timing mismatch between when money arrives and when money is owed. And that mismatch is precisely the gap that overdraft fees, payday loans, credit card carries, and buy now pay later products were designed to fill. The financial industry made an estimated $12 billion in overdraft fees alone in a single recent year. Not from people trying to scam the system, from people whose paycheck timing didn't line up with their bill timing. That is a $12 billion industry that exists because of how Americans get paid, not because of how Americans spend. You think that's an accident? It is not an accident. It is a feature. But let me push deeper because the timing is just the beginning. Now we get to the deductions, and this is where it starts to get genuinely uncomfortable. When you see your gross pay on your pay stub, that's the number your employer technically agreed to pay you. But you never actually see that number in your bank account. By the time it lands, federal income tax has been removed, then state income tax in most states, then Social Security, then Medicare, then your health insurance premium, if you're lucky enough to have it through work, then your 401k contribution, if you can afford one, then maybe dental, vision, life insurance, disability, parking, union dues, garnishments if you have them. For the average American worker, somewhere between 25 and 40% of the gross paycheck disappears before the deposit even hits. And here is the part that nobody walks you through. Almost none of that vanished money is something you have any real-time control over. You can't restructure it on a tough month. You can't pause your federal withholding because your kid needs braces. You can't redirect your Social Security contribution to your rent. The deductions are non-negotiable, automated, and invisible by design. This is what economists call payroll opacity, and it is one of the single most powerful tools ever invented for separating workers from their own money. Because when you can't see something leaving, you can't fight to keep it. And when you only ever interact with your net pay, the number that lands in your account, you stop noticing the giant share that never arrived. Let me make this concrete with numbers, because vague is how this conversation gets buried. Consider an American making $62,000 a year, roughly the median household income. On paper, that's a salary of about $5,167 a month gross. After federal income tax of roughly $475, state income tax averaging around $180, Social Security of $320, Medicare of $75, a health insurance premium of around $220 for a single employee, and a modest 6% 401k contribution of $310. The actual take-home is approximately $3,587 a month. That's a 30.6% reduction. You earned $5,167. You see $3,587. The $1,580 difference is gone before you ever touched it. And while some of that money is theoretically working for you in retirement accounts or future Social Security benefits, a lot of it is just gone. Federal income tax doesn't come back to you. State income tax doesn't come back. Medicare, you'll see, maybe when you're 65, if the system still exists in its current form. But here's where it gets even more brutal, and almost nobody runs this number. Of the $3,587 you actually take home, your fixed obligations, rent, car, insurance, utilities, debt minimums are already calibrated against that net number, not the gross. Landlords don't price rent based on what you would have earned. They price it based on what regional take-home pay can absorb. Car dealers don't structure loans against your gross. They structure them against your net. The entire cost of living layer in America has, over decades, slowly auto-adjusted to consume nearly the entire net paycheck of nearly the entire working population. This is the part that should keep you up at night. The system isn't pricing your costs against what you earn. It's pricing your costs against what you keep after taxes, which means the more your taxes go up, the more your wages have to rise just to maintain the same standard of living, and the more your standard of living lags behind your nominal pay raises. You could be making 8% more than you did 3 years ago and feel poorer, and the reason isn't that you're delusional. The reason is that your take-home grew slower than your tax bill, and your costs grew faster than your take-home. By the way, if any of this is hitting for you, drop a comment letting me know which part. The algorithm reads engagement, and engagement is the only thing that pushes this kind of content past the financial entertainment stuff that doesn't actually help anyone. Let me bring this back down to the human level, because this is where it stops being abstract and starts being a Tuesday morning. I want you to meet someone. His name is Marcus. He's 36. He works as a warehouse supervisor at a distribution center outside Indianapolis. He makes $68,000 a year, and after the deductions I just walked you through, he takes home approximately $3,800 a month. Marcus is not reckless. He drives an 11-year-old Ford Focus. He hasn't taken a real vacation in 4 years. He doesn't have a gym membership. He doesn't have streaming subscriptions beyond the one his sister shares the password to. His rent is $1,250 a month for a one-bedroom apartment in a building that hasn't been renovated since 2003. His car insurance is $148. His phone is $65. His utilities run about $140. His groceries are roughly $380. His gas is $200. His student loan payment is $290. His credit card minimum is $90. That's $2,663 in fixed monthly obligations, which leaves Marcus with $1,137 a month for everything else. Haircuts, doctor copays, birthday gifts, the occasional dinner out, replacing his work boots when they fall apart, and, theoretically, saving for the future. In a typical month, Marcus saves $0 to $40 because something always comes up: a car repair, a medical bill, a wedding to attend, a friend in town, a holiday. You think Marcus has a discipline problem? He doesn't. Marcus is doing exactly what the system was designed to produce. A worker productive enough to keep the economy running, paid just enough to keep showing up, with just enough margin to avoid total collapse, and not 1 cent of structural surplus that could ever translate into actual financial independence. That is not a personal failure. That is the design specification of the American paycheck for tens of millions of workers, and it is producing exactly the outcomes it was calibrated to produce. Now let me give you the third layer of the trap, because this one is the one almost nobody connects to the paycheck at all: health insurance. For most Americans who get insurance through their employer, the premium is deducted from your paycheck pre-tax, which sounds like a benefit. And on paper, it is. The cost is reduced because you're not paying income tax on that portion. But here's the trick. Employer-sponsored health insurance is the single most important reason Americans cannot easily change jobs. It is the chain that ties you to a workplace, even when the workplace is making you miserable. Because if you quit without a replacement job lined up that offers comparable coverage, you are now looking at either COBRA, which can cost $700 to $1,400 a month for a single person, or a marketplace plan, which is often even more expensive without employer subsidy. So your paycheck doesn't just contain the deductions for healthcare. It contains an implicit lock-in. The healthcare deduction is the price you pay to remain insured, and the insurance is the leverage your employer has to make sure you keep showing up. The structure is not subtle. The structure is the point. This is why wage negotiation in America functions differently than wage negotiation in countries with universal healthcare. When your health insurance is structurally untied from your job, you can walk away from a bad offer. When it isn't, the cost of walking away includes the potential cost of medical bankruptcy if anything goes wrong during the gap. And so you don't walk away. You renegotiate from a position of weakness. And the wage stagnation that has defined the last 40 years of American working life is partially, not entirely, but partially the downstream consequence of that single structural fact. The paycheck doesn't just pay you less than it should. It also prevents you from credibly demanding more. I want to say something now that's going to be uncomfortable, because I don't think this conversation can be honest without it. The reason the paycheck trap persists, the reason it doesn't get reformed, is not that policymakers don't understand it. They do. Tax withholding, pay frequency rules, employer-tied benefits, and the entire payroll apparatus are well documented, well studied, and well understood by virtually everyone in a position to change them. The reason the system persists is that the current structure benefits an enormous web of intermediaries who would lose revenue if it were simplified. Payroll processing companies, tax preparation services, the overdraft and short-term lending industries, health insurance administrators, retirement plan administrators. The structure is complicated not by accident, but because the complication itself is the product. Every layer of friction in your paycheck is somebody's business model. And there is no organized constituency for simplification, because the people who would benefit from simplification, you, are too exhausted from navigating the complication to organize against it. That is not a conspiracy. That is just how slow accumulation of vested interest calcifies into structural inertia. And it is the reason the paycheck of an American worker in 2026 still functions, in many ways, identically to the paycheck of a worker in 1986, despite 4 decades of technological progress that should have made every part of this obsolete. So what do you actually do? Because I'm not going to do what most channels do, which is describe the trap and leave you sitting in it. Here are 3 specific things, not generic advice, that genuinely move the needle. First, you need to understand and audit your gross to net ratio, not just stare at your deposit. Pull up your last pay stub. Look at the gross. Look at every single line item between the gross and the net. Write down which ones you can actually influence and which ones you cannot. Federal income tax, you can influence through withholding adjustments, especially if you consistently get large refunds, which just means you've been giving the government an interest-free loan all year. Health insurance, you can sometimes influence by choosing a higher deductible plan if you're healthy. 401k, you have full control over within plan limits. Most workers have never actually looked at their pay stub line by line in their entire career. That single hour of forensic accounting will tell you more about your real financial position than any budgeting app ever will. Second, you need to fix the timing mismatch deliberately. The reason most Americans are perpetually one bad week from disaster is that their inflow timing does not match their outflow timing. The fix is not magical. It is to build a 1-month timing buffer in a checking account that you do not touch. Not an emergency fund, a timing fund. 1 full month of your fixed obligations, sitting there doing nothing, just absorbing the mismatch between when bills are due and when paychecks arrive. Once you have it, the entire psychological texture of payday changes. You stop scrambling. You stop overdrafting. You stop relying on credit cards to bridge the gap. It is the single most undervalued financial move in personal finance, and almost nobody teaches it because there's no product to sell you alongside it. Third, and this is the one that nobody wants to hear, you need to start treating the gross number as your real wage, not the net. When you negotiate a raise, negotiate against gross. When you evaluate a job offer, evaluate against gross plus benefits, and run the actual tax math against your specific situation rather than assuming the comparison is apples to apples. When you think about whether to take a higher paying job in a higher tax state, run the net calculation, because a $10,000 raise in a state with a 6% income tax is not the same as a $10,000 raise in a state with no income tax. The system trains you to think in net terms because thinking in net terms hides the size of what's being taken. Thinking in gross terms forces you to confront the full picture, and the full picture is the only basis for any real financial decision. Look, I want to leave you with this because I think it matters more than any single tactic. The reason Americans feel broke, even when they're earning more than ever in nominal terms, is not that they're delusional and not that they're bad with money. It's that the paycheck itself has been quietly engineered to deliver them just enough to keep going and not $1 more than that. The trap is not in your spending. The trap is in the structure of the instrument you receive your spending money through. Once you see that clearly, the question stops being, how do I stretch this paycheck further? The question becomes, how do I work with, around, and eventually outside this system, so that the paycheck is one input among several rather than the single lifeline holding my entire existence together. That mindset shift is not solved by any single video. But it starts here with seeing the trap for what it is and refusing to keep blaming yourself for being stuck inside something that was specifically designed to keep you stuck. This is the kind of stuff the Breadline fix exists to pull apart. If this video helped you see your paycheck differently, the best thing you can do is share it with somebody else who's been quietly blaming themselves for living check to check. They deserve to know it isn't their fault. I'll see you in the next one.